I am sure all of you noticed that the stock market started to fall massively on Thursday and Friday. The S&P 500, the Dow Jones, and the Nasdaq dropped between 3 to 6% within 2 days. And we have stocks like Apple that has dropped more than 13% within a week, Tesla almost 30%, AMD more than 13%, and then we have stocks that are surprisingly going up, such as Royal Caribbean and Carnival, and the banking industry. And today the stock market is down even more, so let's see how the day ends. So in today's video I will talk about stocks that I would buy in a market crash. These are stocks that I either already own or I would like to start a position on since they seem very attractive. I do have to say that obviously there are other stocks out there that look very attractive and could give you excellent return, but these are the ones that I'm currently watching. Something that I want to make clear, obviously it is not nice to see your portfolio going down on this like this, but it is definitely healthy for the stock market. You can think of it as an opportunity to invest instead of a time to sell because you are losing money. Remember that you do not lose money until you sell, and times have taught me that selling is not always the best option unless fundamentals have changed or you think that your money will do better in other places. So these stocks are, in my opinion, good options to invest on during market crashes. Remember guys that I'm not a financial advisor and you should do your due diligence before investing in anything. The first stock in this list is obviously Apple, ticker symbol AAPL. I do have to say that I used to be an Apple shareholder. I love their products, their services, everything they do. I did had a good return with Apple when I decided to sell. At the moment I decided to sell because their valuation was not making sense, and well, I learned my lesson. I've sold some stocks during my path in the stock market, and time have taught me that I should not sell and just invest in the long term unless something drastically changes. After selling Apple and seeing where it is right now confirms that theory of just buy, forget about it, and hold for the long term. Obviously, it is difficult sometimes to do that when feelings get in the way, but we have to learn how to be patient with our money. Apple is trading at a price of $116 per share, and it is down 3.38% more today at a time I'm filming this video. I do have to say that the PE ratio in the 30s for Apple might be a little bit rich, but I like their last earnings report. They reported a growth of 11% in sales even with the pandemic, and 11% might not sound that huge, but when you are a $2 trillion company with a revenue of $59 billion, it is actually huge. They beat analyst expectations in revenue by more than 14% and by 26% in earnings per share. What impressed me the most is that their iPad segment actually had a growth of more than 30% year over year. I do think that the pandemic has helped them a lot since a lot of people are working from home, kids have online classes, and might needed to buy new laptops and iPads. In my opinion, they have a healthy balance sheet, and yes, their long-term debt has been increasing a lot year over year, but they still have $317.3 billion in total assets and $245.06 billion in total liabilities. For me, this is a stock to buy and always hold. I'm looking to buy this stock if it gets between $100 and $110 per share, which on Friday it got to $112. So if the stock market continues crashing, we might see those prices. The second stock in this list is Lyft, ticker symbol LYFT. As many of you may know, I've been investing in Lyft since February and still find it very attractive. In my opinion, the stock has been punished a lot since it went public, and I do see potential in it. Lyft is only available here in the US and Canada, and yes, Uber is already available in more than 80 countries around the world and is way bigger than Lyft, but just imagine the expansion capability Lyft has around the world by only being in 2 countries. I know that there has been a lot of bad news recently around the ride-sharing industry in California, since California wants Lyft and Uber to treat their drivers as employees and not as independent contractors, and that could bring huge expenses to both companies. I do want to see what will happen in November. On November 3rd, there will be an election in which people will decide what will happen next with these companies. If they vote yes, they support this ballot initiative to define app-based transportation and delivery drivers as independent contractors and adopt labor and wage policies specific to app-based drivers and companies. If they vote no, then they oppose this ballot initiative, meaning the California Assembly B5 5 could be used to decide whether app-based drivers, employees, or independent contractors. This is very important for two reasons. The first one is that California accounts for 16% of Lyft drives, and having to put their drivers as employees would increase the company's cost. The second one is if the bill passes and they have to qualify their drivers as employees in California, other states might want to do the same and start with this as well, which again, it is not the best option for both companies. I'm investing in this company mainly because of the growth potential that they have, their exponential growth, and their balance sheet. They have $2.7 billion between cash and cash equivalents and short-term investments. They have total assets of $5.2 billion and only have $623 million in long-term debt, and have total liabilities of $2.9 billion, which is just $0.2 billion more than their cash positions, and that is very, very healthy. The third stock in this list is Facebook, ticker symbol FB. I have always said that this is the kind of stock that has always been a buy for me. They are growing exponentially, and analysts are still expecting them to have a growth of 13.4% in revenue this year and then get back to their normal growth of 24% by next year. Facebook is one of the biggest advertising companies competing with Amazon and Google, and this year they decided to enter a little bit more into the e-commerce world. Earlier this year they launched Facebook Shop, and in my opinion that is going to be huge for Facebook because a lot of small businesses will want to spend even more money in advertising, trying to sell their products and make people learn about their brand. We have all seen how e-commerce has been growing year over year and how it accelerated its growth this year due to the pandemic, and Facebook entering into the e-commerce business will definitely bring them huge growth as well. This is a stock that I am up right now almost 40% and still think it has potential in the long term, even at current prices. The fourth stock in this list is Google or Alphabet. This is a stock that has always given very good returns, and I think it will continue in the long term. Google has seen exponential growth, and analysts are expecting them to get back to 20% growth by 2021. Google is the largest search engine with over 70% of market share and captures almost 85% of mobile traffic. They also own YouTube, which is also a huge search engine and mostly with today's generation. Everything you want to learn is either on Google or YouTube. You can learn how to code, cook, another language, where to travel. Alphabet is a company that is always trying to innovate even more their business. For example, they own a company called Waymo, which is an American autonomous driving company, and we all know that this is going to be the future. They also have a cloud service that is growing and growing year over year. I do understand that this stock got to all-time high last week, but this pullback might be a good opportunity to buy, and even more if it continues dropping. My fifth stock in this list is Lemonade, ticker symbol LMND. If you're new to my channel, I do recommend you go and watch my last two videos talking about this stock. You guys know that I find this stock very innovative and has a huge possibility of disrupting the insurance industry with technology. We all have seen how fintech companies were able to disrupt the banking industry with technology, and how Tesla is doing the same with the car industry. In my opinion, if Lemonade does everything right and take the right choices, they will be able to do the same with the insurance industry. I think that their AI or artificial intelligence is very innovative, and yes, I know that they have been having some errors since they launched, but that is normal because the AI gets better with time and with more data. And all it has been doing since they launched their service is collecting data. Also, I like their plan to target mainly young people that have never had any insurance before and grow while they grow. I do have to say that this is a risky and long-term investment because they are a very new company that still needs time to improve even more their service, but as of right now, I already like what they are offering. Something that caught my attention about this company, other than their technology, is their potential. Right now, they are only available in some states here in the US and only 2 countries in Europe. Again, this is a risky and long-term investment for me. I started buying in August and have been adding to my position little by little, and will add more with this crash. But you guys have to take into consideration that they are brand new and they just went public, so I'm also waiting for the lockup period to end. Also have to take into consideration that because it is a new and innovative and disruptive company, we might see a lot of volatility over the coming months. My last stock in this list is American Express, ticker symbol AXP. Even though American Express is a credit card issuer company, it is directly related with travel. Due to the pandemic, they got affected for two main reasons. The first one is that at the beginning of 2020, people lowered their expenses. Therefore, they lowered their credit card usage. The second reason is travel. Every single person stopped traveling around the world, and American Express is a company that benefits from travelers that use their credit cards to gain more points to travel even more. Because of all that, American Express has underperformed the industry, and as you can see, their stock has not been able to fully recover from the crash in March. In my opinion, while everything starts getting back to normal and people start traveling again, American Express will see a growth in their revenue again, and the stock will recover and might even get to all-time high. And also what I like about them is their dividend that they are currently offering, which is very stable in the company. So I think that this might be an excellent investment opportunity right now. Again, I'm not a financial advisor, so do your due diligence before investing in any of these companies. Also remember that I have a free Discord group chat. The link for that is down below in the description if you want to join. Hope you enjoyed this video. Please smash that like button and subscribe since it really helps my channel out. Thank you and see you next time.